Hi everyone, welcome back to Saheb Academy. Today in this video we are going to understand what are adjusting entries. We are going to understand this in very much detail, the meaning of adjusting entries, who will pass these entries, when are we going to pass them, why is this necessary, what's the logic behind this, and we have heard we always pass the adjusting entries. Why do we always need adjustment? Yeah, all these things we are going to discuss. What are the different types of adjusting entries? How are they different from rectification entries that we have? And then we have also heard about reversal entries. What are those reversal entries? How are they connected with adjusting entries? All these questions we are going to answer in this video. So please hang on with me till the end of this video and you will be completely clear with this concept. Okay, so let's begin. Let's understand the adjusting entries. Now see, here we have the concept of adjusting entries. It's really simple and straightforward. These are the entries which are passed at the end of accounting period. Normally accounting period consists of 12 months and the end is usually on 31st December or 31st March. So at this time these entries are passed by the senior accountant to make some adjustments in the accounting records so that financial statements can be prepared. So this is done prior to preparing the financial statements. And let me tell you, see, the accounting standards, whether it is IFRS, Ind AS or Indian GAAP or US GAAP, yeah, all the accounting standards says that companies have to follow accrual basis of accounting. They have to prepare financial statements on accrual basis of accounting, not on cash basis. Cash basis is not allowed. Cash basis is only for small businesses. Okay, so because of that, adjusting entries are passed because we are following accrual basis of accounting. Okay, fine. So what happens in this adjusting entries? Let's understand. Let's just read this here. Entries passed at the end of accounting periods to update the balance of certain accounts or to record the unrecorded transactions according to accrual basis of accounting. So it becomes very important to understand what happens in this accrual basis of accounting. See, it's really simple. Accrual basis means whatever that has happened in your business, you have to record that. That's what basically it means. Yeah, if we break down the accrual basis, then we find there are two accounting concepts in this basis. First, we have accrual concept, which says revenue or income is recognized, which means it is recorded when it is earned, not when cash is received. Okay, expense is recognized when it is incurred, not when cash is paid. Is that clear? Simple and straightforward. You will not see the cash flow. Whatever that has happened, revenue which you have earned and expenses which you have incurred, you will record that. Okay, you will not see the cash flow where the cash has been received or cash is paid. Okay, that's not the thing over here. That's cash basis. Okay, then we have the matching concept in this. What does matching concept says? Matching concept says that revenue of the period should be matched with the expenses of the same period. For example, let's just say you sold 50 pens. Okay, 50 pens you sold. Then what you have to do, you have to take the revenue, the sales of those 50 pens in your income statement or in your statement of profit and loss as revenue. You have to recognize that, and at the same time you have to take the cost of that 50 pens only. Yeah, the cost of goods sold we call it, or purchases. Fine. You can't take what do you say, let's just say you have purchased 500 pens in that same period, in that same accounting period. Still you can't take 500 pen cost. That's completely messed up. You have to take only 50 pens. You have to do proper comparison. Revenue of the period should be matched with the expenses of the same period. Yeah, even though you incurred the cost of that, you purchased those 500 or 300 pens in that same period, but it doesn't belong to this period. It has not been sold yet. Only 50 pens have been sold. You will only match 50. Okay, the remaining whatever is there, 450 and all, that will be sold in the next accounting period. It will be an expense of the next accounting period. Is that clear? Yeah, that's the thing. Okay, this is the matching concept. Fine. So these are the two main concepts. So see here, let me just show you the basics of financial statements. You have to understand this properly. Yeah, all the accounting standards says that we have to follow accrual basis of accounting, not cash basis. Fine. First thing. Second thing, see here, this is the accounting period. 1st April 2024 ends on 31st March 2025. So in this accounting period, whatever expenses that has been incurred will come over here. Whatever revenue or income you have earned will come over here. And this is what should appear in your statement of profit and loss. If there are any expenses or any revenue which you have received or paid, yeah, expenses paid or revenue received, just cash, okay, you have not earned, you have not incurred. Incurred means you have taken the benefit. Okay, let's just say you have paid insurance in advance of the next year, you have paid rent in advance, so you have not taken the benefit, you are yet to take benefit, and that will happen in the next accounting period. Yeah, such type of income or expenses should not come in this statement of profit and loss. Okay, that's the main idea you have to understand. It should appear in the next statement of profit and loss of the next accounting period, because it belongs over there, right? What should come in this statement of profit and loss? In this statement of profit and loss, only expenses which have been incurred in this accounting period, revenue which has been earned in this accounting period, only that should appear over here. And understand, statement of profit and loss or profit and loss account, this is prepared for the entire period. Yeah, it shows, you know, all the expenses you have incurred in this period, all the revenues you have earned in this period. Is that clear? For the period ended on 31st March 2025. Okay, and it shows us the financial performance, whether we have made profit or loss. And then on the other hand, we have balance sheet, which is a snapshot of your business. Balance sheet shows us the financial position of the business at a specific point in time. On 31st March 2025, how much cash did we have? How much furniture did we have? How much plant and machinery did we have? Right? How much assets do we own? How much liabilities we have to pay? How much equity do we have? The residual interest of the equity participants, right? The owners, right? The capital, isn't it? So that's the thing. Fine. Basics of financial statements. You understood this, right? So sometimes what happens is, these things will not be exactly like this, okay, because of some reason. So that is why adjusting entries are needed to make the accounting records exactly like this. Expenses incurred in this accounting period only will go in statement of profit and loss, and revenue or income earned in this accounting period only will go in statement of profit and loss. To make this happen, adjusting entries are passed. Okay, and then there can also be some other adjustments and all, but mainly it's this. Is that clear? It won't be like this. It won't be like this. Believe me, accounting records won't be like this. The senior accountant has to come at the last of the year, at the end of the year, and make some adjustments and make sure the financial statements are accurate. They are following the accrual basis of accounting, which means accrual concept and matching concept. If adjusting entries are not passed, then what happens? If adjusting entries are not passed, then see here, what will happen is your financial performance, the profit or loss which you find in statement of profit and loss will be wrong. Your financial position will be inaccurate, okay, which is shown in the balance sheet. How much assets you have, liabilities and all, right? It can be overstated or understated. Fine. See, if financial statements are prepared without adjusting entries, then profit and equity would be what? Overstated or understated. Yeah, anything can happen because financial statements are not in accordance with the accrual basis. So the basic thing is what this guy does, this senior accountant, he makes sure that the financial statements are in accordance with the accrual basis of accounting by making last minute adjustments or last fine tuning in the accounting records. Is that clear? Let me just show you the accounting cycle. This slide of the previous video, right? These 10 steps. So see here, this is the adjusting entries stage, 7th stage. Yeah. Trial balance unadjusted. From this worksheet is there, and then adjusting entries are passed, and then adjusted trial balance, and then financial statements are prepared. Okay, that's the stage of passing adjusting entries. Fine. So the important thing was what? Accrual concept, matching concept, right? So let me tell you why adjusting entries are passed, at the end of every accounting period. Why every time we need adjusting entries? Let me tell you. See, it's really simple. To keep the accounting process simple, what we do is we tell the bookkeeper or the cashier or the junior accountants that you guys always focus on the routine transactions, simple routine transactions. Yeah, see here, bookkeeper or cashier is not able to apply these concepts. They have limited knowledge. Okay, they are freshers with limited experience and they are just doing recording. What is bookkeeping? Bookkeeping is not preparing financial statement. Understand, bookkeeping is only this. Bookkeeping is, identification, source document, journal, posting, trial balance, over. Bookkeeping is over. If there are any errors over here, that also they will rectify. Over there only, it's over. This is called bookkeeping. Okay, only this much. And then after this, preparing financial statements and everything will be the job of the senior accountants, right? So these bookkeeper guys or the cashier, they will not have access to all the data and everything, okay? And they will just focus on routine transaction, right? And if they are following this accrual concept, matching concept also, then they will not follow it exact correctly, okay? They will record everything in a lump, all together in entirety. Okay, what does that mean? We'll see that practically when we'll take the examples in the coming videos. Fine. So this is the thing. So let me just show you how it all happens. Okay, see here, adjusting entries are part of the, see here, adjusting entries are planned part of the accounting process. Okay, we have deliberately kept it like this. See, understand properly. This is the process called as bookkeeping, from identification of transaction till the unadjusted trial balance. Okay, this entire process. Fine. Source document, then the journal. Journal consists of two things. You all know now, subsidiary books and then the journal proper, or it's also known as books of prime entry or general journal. Yes, and then you have ledger postings, which we do in the general ledger or just ledger, you can say. And then trial balance is prepared from all the debit and credit balances which we get from the ledger. Right, so all this is done by the junior accountants or the bookkeeper and all, and there can be many people also involved in this. You have to understand this properly. Okay, maybe cashier has cash book, sales book is with the salesperson, purchase book is with the purchase manager. Okay, it's like that. Is that clear? So all that will be compiled. There can be errors and all, and then there will be accountant, junior accountants who are recording all this. Okay, so that's what happens. Think about a big company, right? The systems can be very complex. Is that clear? Okay, so this is what will be happening. Okay, bookkeeper will do till here, right? And I mean senior accountants or the chief accountant, they will tell the bookkeepers, see, what you have to do, your main job is just recording the transaction. Yeah, you have limited knowledge already, you don't have considerable experience, and then there is heavy workload, so many transactions you have to record in a single day. So you just focus on basic, simple, routine transactions. Whatever you don't understand or whatever is difficult, yeah, don't do that, right? Focus on day-to-day recording of cash transactions and credit transactions, yeah, the routine ones, and leave other adjustments, any complex thing for senior people to handle, okay, to simplify the accounting process. Is that clear? Simple. So what will happen is, okay, all that will be recorded, fine, in the entire year, regular transactions will be recorded. And then at the year end, the senior accountant will come. Of course, during the year also, they will be overseen. Okay, supervision will be there. Okay, if they have any doubts and all, that will be cleared and everything. But at the year end, I'm talking about, in the year end, what will happen? See, at the end of the accounting period, 31st March or 31st December, senior accountant will come. He will take the trial balance, yeah, unadjusted trial balance, yeah, and all the accounting records, and he will prepare the worksheet. Now, what is this worksheet? Worksheet is nothing but just a rough paper, okay, or a spreadsheet, you can say, where you list everything all together. Trial balance, ledger, balance sheet, statement of profit and loss, okay, all the things will be there in just one sheet. All the summary will be there, and then he will see, is there any inaccuracy, any error? If there are any errors, then that will be rectified in the general journal or the general proper. Okay, so he will do that. Okay, so rectification of errors will happen over here. Now you have to ask yourself, how rectification entries are different from adjusting entries. Let me tell you, it's really simple. Adjusting entries will always be done at the end of accounting period. These are the planned part of the accounting process. Whereas it's planned part. Now we have told the bookkeeper, you stay away from the difficult thing, just do easy routine things. Yeah, whatever difficult things will be there, we'll do that at last, at the end of the accounting period. Yeah, that's what we said to bookkeeper. So definitely there will be adjustments that senior accountant will have to do at the year end, isn't it? So these are the planned part of accounting process, the adjusting entries, the modification that has to be done in the accounting records, so that we can bring that in accordance with the accrual basis, right? But rectification of errors are not planned. Okay, errors happen, what do you say, just like that. Yeah, we have not planned the errors and all. Yeah, maybe bookkeeper will do some errors over here, and he will, what do you say, he or she will identify the errors and rectify over here only in the general journal, and then trial balance will be prepared. But still after that there can be errors which have been gone unnoticed by the bookkeeper, but it has come to the attention of senior accountant, so he will be rectifying those errors again over here. Is that clear? By passing the rectification entry in the general journal. Here rectification entry will not be prepared. Worksheet is just work paper, man. Worksheet is just for calculation. Is that clear? Okay, it's just a manual process. Fine. So that's what will happen over here. That's how rectification entries are different. Okay, fine. After rectification of errors, then adjusting entries will be passed. Okay, senior accountant will see lots of different types of adjustments are required. Okay, there are different types of, what do you say, adjustments that are done. See, let me just show you types of adjusting entries: outstanding expense, prepaid expense, accrued income, deferred income, depreciation, bad debts recovered, provision for doubtful debts, provision for discount, closing stock. Yeah, if you're talking about this single owner business, yeah, proprietorship, yeah, non-corporate, then there will be interest on capital, interest on drawings, yeah, and then see a deferred revenue expenditure, abnormal loss, manager's commission on profit, goods used other than sales such as donations, samples are given, used in the construction of any asset or maintenance of the business, or goods used by owner for his personal use, any other provision is required. Lots of different adjustments can be there depending upon the cases. Okay, so adjusting entries will be passed. Fine, we have not discussed any adjusting entries. I'm just showing you, I've just given you an overview what all adjusting entries can be there. Okay, so adjusting entries will be passed in the general journal only. Fine. Okay, so modifications are happening because of rectification of errors, balances have been changed. Because of adjusting entries, lots of balances have been changed, right? So this trial balance is useless now. This trial balance is useless now. Why is it useless? We can't prepare financial statement from this because we have made changes. Because of those changes which we have done, and we have updated the worksheet, right? We have done the calculation over here, and here also there is updation. So ledger, everything will be updated, and then we have to prepare the next trial balance, new trial balance, that's called adjusted trial balance. From here we started, we did some changes, right? Then we came to the new trial balance. Is that clear? New trial balance. With this new trial balance, after passing the rectification entries and adjusting entries, we'll prepare the financial statements. What financial statements? Statement of profit and loss, and then balance sheet, and then cash flow statement, statement of changes in equity, and then notes to financial statements or any other explanatory material. Okay, right, financial statements will be prepared, and then we'll close the books. How do we close the books? By passing the closing entries. All the expense and incomes account will be transferred to profit and loss account, right? Isn't it? Yeah, and we'll close all the expense and incomes account because those are nominal or temporary account which always needs to be closed at the end of accounting period. And then we'll prepare closing trial balance. In closing trial balance, we'll take what? We'll take only asset category accounts, equity category accounts, and liability category accounts, and we'll see, have we closed all the expense and income accounts, right? Is it matching? Yeah, that's what we will confirm the accuracy, and then books will be closed. Fine. So after this, new accounting period will start, next year, right? Then only we'll do this also. Opening entries will be passed in the new accounting records, and reversal entries will be passed. Now you have to understand what are these reversal entries. Don't worry, we'll see practically what are reversal entries when we'll do the example. But right now understand what we do is, whatever adjusting entries we have passed over here, some of the adjusting entries will be reversed over here. Some of the adjustments, will be reversed over here. Is that clear? Okay, so that's the thing. This is the entire accounting cycle, and I have explained how adjusting entries come in between this. Fine. So you understood now why do we always need adjusting entries? Because the accounting process is designed like this. Bookkeepers, they just focus on day-to-day recording of transaction. They do not completely follow the accrual basis of accounting regular basis. Yeah, in real world, they will not follow accrual basis completely 100%. No, they will break the accrual and matching concept. Yeah. So that is why, to keep things simple, it's like that. Okay, because understand, see here, lots of transactions are happening, and then the systems can be complex, right? So because of that, the cashier also will not have access to all the data. Cashier, let's just say cashier has cash book, so he's just recording whatever cash is coming, whatever cash is going out, he's just recording that. And then bookkeeper is there, he also doesn't have the access to all the data, so some of the entries and all will always be missed. That will be taken care of by the senior accountant at last. Is that clear? So this is a deliberate process, adjusting entries. Okay, rectification entries are not like this. Fine. So this is the concept. Okay. So now in the next video, what we have to do is, let me just show you. See here, this adjusting entries. Yeah, popularly adjusting entries means just the 4 entries. Okay, 2 accruals and 2 prepayments. Prepayments are also called as deferrals. Okay, if you search online or Google, then you will find adjusting entries are just these 4 entries, and then there are estimates also of depreciation and bad debts and all. Okay, so we'll focus mainly on that only. See here, accrual concept, because of accrual and matching concept, we have 4 main adjusting entries. 2 are related with expenses and 2 are related with incomes or revenue. Okay, outstanding expense, prepaid expense, accrued income, and then deferred income. Now these also have different names. See here, outstanding expense is also known as, AKA accrued expense, unpaid expense, expense payable, and then prepaid expense is also known as deferred expense, unexpired expense, expense paid in advance. Okay, accrued income, income earned but not received, income receivable. Okay, lots of different names are there, so you have to be careful. Okay, you have to know all these things. If you want to be proper accountant, then you must know everything. Okay, then deferred income is also known as what? Income received in advance, unearned income, pre-received income, unaccrued income. Okay, or prepaid income also some people call this. Okay, how can income be prepaid? But you have a term like that in some books. Okay, now accruals and prepayments means, see here, outstanding expense and accrued income are called as accruals. Okay, and prepaid expense and deferred income are called as prepayments or deferrals. Okay, so this is the entire thing, this is the overview. So what are we going to do is, in the coming videos, we'll have one video on this, one video on this, one video on this. Okay, like that. Is that clear? And that's how we are going to completely break down each of these categories with the proper example. Fine. Okay, so don't worry, in the coming videos we'll completely be clear with this. Fine. And then there is also one more concept that I have to make you understand over here, that is of difference between accrue and due. Okay, let me just show you. See here, difference between accrue and due. Accrue means to accumulate, right? To increase over the period of time. Fine. Accrue. Due means timing of payment or receipt. Okay, this is very important for you to understand. It's a basic terminology, but you have to understand this properly, right? Accrual concept, right? Recognize expenses when they are incurred and recognize income when they have been earned, right? Simple. So we follow accrual concept, matching concept, you all know that, right? So let me tell you, accounting is done according to the accrual concept. Whatever that has happened in the business, we record that, right? But payment or receipt actually in the company will happen when they are due. In reality, the payment or receipt will happen when they are due. What does due means? Due is the timing, when the time will come, right? So see here, let me just give you an example of salary. See here, salary example. Let's just say this is 1st March, this is 31st March. Okay, at the end of accounting year, see, this is the end of accounting year, right? This is the year end, right? So salary of March will be paid in the next month, that is in the next year, 7th of April, right? 1st March 2024 to 31st March 2024. This is the current accounting period, isn't it? yeah, current accounting period, and then right after this 1st April 2024 to 7th April 2024 is what? This is next accounting period, isn't it? So see, here salary will not be paid. Salary will be paid on the due date, 7th of April. If you'll ask your father, then he will tell you salary is not received in the same month. It will be received mostly in most of the companies in the next month. Okay, but the accounting will happen on 31st March only. Salary entry, the double entry or the journal entry will happen over here, which is the adjustment entry actually, right? In the next month on the first day there will be a reversal entry, and then actual normal entry will happen on 7th April, the payment of salary entry. Okay, this is what will happen. Don't worry, we'll see an example of this in the first video only of outstanding expense, and then you will understand this. Okay, so let me tell you, salary accrues daily throughout the month. Every day your dad is earning the salary. He is working every day, right? So every day he is, what do you say, earning the salary. Salary is getting accrued, it's getting accumulated, but it is paid on 7th of April. Yeah, is that clear? So you have to understand this. Accrue and due are two different concepts. Accrue means to accumulate. Salary is getting accumulated every day, part by part, slowly, as your father is providing service, right? But your father will get the salary in his bank account on 7th of April. That's the due date. Payment will be done over here. Is that clear? So this is the difference. That's very important for you to understand. So that's all for this video. I hope you have understood the entire concept of adjusting entries. Now in the next video, we will start with the outstanding expense, okay, or accrued expense also it's called, and we'll be completely clear with that, and then we'll move on with all these popular adjusting entries. Okay, so that's all for this video. See you in the next video. Bye.